Hi everyone. So far we have learned about monetary policy and how the central bank can implement an expansionary monetary policy by expanding money supply, and that would lower the interest rate, or apply or conduct a contractionary monetary policy by reducing money supply, which will lead to a higher interest rate. So in this video, I will talk briefly about the concept of the liquidity trap, a situation in which increasing the amount of money or liquidity does not have an effect on the interest rate, so the liquidity is trapped, which a concept was developed by John Maynard Keynes in the 1930s. So what is the main idea here? So if the central bank wants to increase the interest rate, it decreases the amount of money in the economy. And if it wants to decrease the interest rate, then it increases money supply. So in this video, we'll see that there is some limit here, or some limitation to how much this can work, or the effect of monetary policy can work, depending on how low the interest rate can go. So the interest rate cannot go below zero, which is a constraint known as the zero lower bound. When the interest rate is down to zero, then monetary policy cannot decrease it further. So we cannot decrease, it cannot go below zero. And in such case, monetary policy would no longer works, and the economy is said to be in a liquidity trap. When we drive the demand for money, we did not ask what happens when the interest rate becomes equal to zero. So if we ask this question now, or it's time to ask this question, so the answer would be, once people hold enough money for transaction purposes, they are then indifferent between holding the rest of their financial wealth in the form of money or in the form of bonds. Remember, we discussed this before, and we assumed that both bonds and money are alternatives, both assets you could use to store your financial wealth. And so choosing between bonds and money, we know money is liquid but might give no return or zero return, and bonds are less liquid but they give some positive return. So once people hold enough money for transaction, if we see a zero interest rate, then once people hold enough money for transaction purposes, then they become indifferent between holding the rest of their financial wealth in the form of money or in the form of bonds. Why? Because at this point, given that the interest rate is zero, then the return on holding bonds is zero, and holding cash or money is the same. So it's exactly as the case of holding money. So the reason they are indifferent here is that both money and bonds would pay the same interest rate, which is basically zero. So in this case, the demand for money is infinitely high. So what is the problem here? So what is the problem if that is the case? We know from before, as we explained, if central banks tries to stimulate the economy, let's say we have a recession and the central bank would like to stimulate the economy. How would they do that? They increase money supply. However, it will be fully absorbed by demand for money. I fails to go further down. I here, or the interest rate here, would actually remain the same, because if we believe in the zero lower bound, meaning that the interest rate cannot go below the zero, so it means here then any increase in money supply it will be fully absorbed by demand for money. Okay, so in a nutshell, that means, or the implication of this is that monetary policy would lose its effectiveness. So it wouldn't be able to affect output anymore. And that is why we call this is a trap caused by infinite demand for liquidity or money. In a liquidity trap, people's demand for money no longer negatively related to the interest rate. Remember, that means it's not downward sloping anymore. But remember what we said when we discuss the factors that determine demand for money. We said it depends on transaction, so which basically depends on income, and then the other two reasons, the precautionary or the speculative demand, these both depend on the interest rate. So given that interest rate here is zero, okay, or very close to zero, then that means the economy is facing a liquidity trap where people actually indifferent between holding money or holding bonds, and that also implies that this negative relationship between money demand and interest rate is no longer valid, because the interest rate is zero or very close to zero. So in that case, money demand will be infinite for this interest rate level, which is sufficiently low or close to zero. And that segment of the money demand curve will be horizontal. So this is basically what I meant by the liquidity trap. You can see here money demand and money supply, this downward sloping part or segment of the money demand, basically when interest rate is high enough. But when the interest rate goes really low, you will see here BC, it becomes like this green horizontal line here. And at this point, money or monetary policy becomes effective because basically because changing money supply here wouldn't really change the interest rate if we believe in that zero lower bound. So the idea here again, when the interest rate is equal to zero, and once people have enough money for transaction purposes, they become indifferent between holding money and holding bonds. The demand for money becomes horizontal, as you can see, this BC segment. This implies that when the interest rate is equal to zero, further increases in the money supply would have no effect on the interest rate, which would remain equal to zero. As you can see here, in increasing money supply or implementing an expansionary monetary policy from MS prime to MS double prime here, that basically moved from point B to point C, that did not really help or did not have any effect on the interest rate. Again, as the interest rate decreases, people want to hold more money and, of course, less bonds. We already know that from before, and that explains the inverse or the downward sloping demand for money curve. So in that case, okay, as the interest rate decreases, people want to hold more money, and therefore the demand for money increases. As the interest rate becomes equal to zero, people want to hold an amount of money that at least equal to the distance from O to B. Okay, so this is basically to cover the need for transaction purposes, but they are also willing to hold more money, and again that means fewer bonds, because they become indifferent between money and bonds. Remember why? Because at this point, given that the interest rate is zero and holding money, we know that return zero, have zero return, but it's the same as the return on bonds, which is zero again. So given that both give the same return, obviously people will prefer holding money to holding bonds, given that money is more liquid asset. So at this point, at a zero level of the interest rate, then people become, or they be willing to hold more money, because they become indifferent between money and bonds, and because of that the demand for money becomes horizontal beyond point B. Now let's say the economy is in a recession, or the government, or the monetary authority or the central bank is considering an expansionary monetary policy through increasing money supply. So let's consider the case where the money supply is MS on this graph. So the interest rate here, the interest rate here, or the initial interest rate or the equilibrium point is A, and that means the interest rate is I. So increasing money supply from MS to MS prime, so that means we move from A to B, so basically that reduced the interest rate. So shifting the MS line, the vertical line, to the right leads to a decrease in the interest rate, and that's how money supply works. How monetary policy works. So changing money supply, and when you change money supply, that will affect the interest rate. So now let's consider now again, just to emphasize what we already discussed, if the case now, if we are at this point B, or at this segment of the demand for money curve, which is horizontal now, because again the interest rate is zero, and now let's assume that now the equilibrium point is B, and we want to increase money supply to point or further to the right. So increasing money supply here is not going, because the interest rate is zero, is not going to influence or to have any impact on the interest rate. Remember, when the central bank increases money supply, it does that through the open market operation. So they basically buy bonds and pays for these bonds by creating money. As the interest rate is zero, people are indifferent to how much money or bonds they want to hold. So they are willing basically to hold less bonds or fewer bonds and more money at the same interest rate, which is zero here. So the money supply increases, but with no effect on the interest rate, which remains equal to zero. This means the monetary policy at this point, or at this segment of the money demand, is not effective.